Hello, everyone. Good afternoon. Thank you for joining us in our webinar today, How Fundamentally Minded Investors Use Technical Analysis Today with Dave Lundgren. My name is Heather Young. I'm on the board of directors of the CFA Society Boston, and this year I'm the chair of education and programs. I will be your host today, but you are not here to hear from me, so let's get into it. Dave Lundgren is a 30-year investment industry veteran with a focus on technical analysis strategies, particularly momentum and trend following. He has held both analyst and portfolio manager positions at several major investment firms, including Wellington Management, Fidelity Investments, and Thomson Financial. In addition, David has started several research and investment firms, including Lundgren Financial Services, Breakaway Research, and hedge fund Lyceum Capital. David also taught a graduate level technical analysis course at Brandeis International Business School in Waltham, Massachusetts, where he was honored to receive the 2015 Excellence in Teaching Award in his first year. David is a chartered financial analyst and a member of the CFA Institute. He's also a chartered market technician and serves on the CMT Association's board of directors. He recently launched the Fill the Gap podcast for the CMT Association as well. Dave graduated with high honors from Babson College in 1988 with a degree in finance and investments. As the conversation unfolds, anytime you have a question, pop it into the Q&A function of your Zoom window. Please do not use the chat function for speaker questions. After Dave's prepared remarks, we will have some time for Q&A, and I will now turn it over to Dave.
Thank you very much, Heather. Thank you for that introduction. I'm just going to go ahead and share my screen here. And hopefully that goes as planned. Can you see my screen? Can you see my screen okay?
Yes.
Okay, perfect. Thank you. All right, wonderful. So we have quite a bit of content to get through here today. Actually, most of these slides are slides that I've, various forms of these slides that I've used in my classes at Brandeis. So what I'm trying to really do here is cram a half semester course into about a 40-minute discussion. So I'll do my best to get through everything here. But our objectives for today are multiple fold. One is to really spend some time discussing the actual links that exist between the fundamental and technical philosophy. So this, I think, is the most, probably the biggest, most prevalent misunderstanding in the investment community with respect to the philosophical underpinnings between fundamental and technical. And I'm hoping, as we go through the discussion today, to really shed some light on the familiarity and the similarities that actually exist and coexist between these two ways of thinking about investing. And then from there, of course, we have philosophy, which I just discussed, and then we have process. So there's philosophy, which is what you believe, and then there's process, and that's how you invest in order to capture that philosophy that you believe. So this is where we differ. Our process is quite different from the fundamental process, and it's different for sure. But the real takeaway for you is to think about how to understand how to think technically and how the processes differ from fundamentals, but in the end to bring them back together into a cohesive strategy that actually rounds you out and makes you a better portfolio manager or analyst. And we'll talk a lot about that. And then I also want to talk about some examples of how the trend can evolve from a positive trend to a negative trend, and how a portfolio manager or an analyst should use that information, particularly from a risk management perspective or from an idea generation perspective. And then we'll talk about as well, I think, one of the most difficult things in investing, of course, is managing your risk. And I think of all the investment styles that are out there, technical analysis actually lends itself best of all the styles that are out there to risk management. And I think, and when you're talking about bringing these different styles together into one cohesive strategy, this is where technical analysis can really fill in a lot of the holes that exist in these other styles. So in addition to help you find ideas, scale your process, and concentrate bets and things like that. What technical analysis can really do is help you manage risk, and we'll spend a lot of time on that as well. And then what I think what we should also do is to highlight some examples. So examples of how you can bring together the power of fundamental analysis and valuation and things like that together with technical analysis to help you guide yourself in and out of your favorite ideas. And then we'll have some time for Q&A at the end. So with that, I'm just going to get started. We have a few questions along the way that I think is going to be kind of fun to they're like polls, and we'll start off with our first poll here, just to get to give me a sense for where the audience is at in terms of their understanding of technical analysis. So on a scale of 1 to 10, how would you rank yourself as a technical analyst? A 1 would mean, oh my goodness, I'm in the wrong webinar, I didn't mean to check in here. Or 10 is, I'm actually a technical analyst and I use it every day. So how would you rank yourself? So go ahead and do that, please. Okay, so we have a pretty good mix here, actually. So that's actually a lot more familiarity with the topic than I typically see when I ask that question. So great, but we do have a pretty broad representation here. Okay, so let's get started with philosophy, the philosophy of technical analysis. So if we think about the core principles that drive the technical strategies, many of the technical strategies that you'll learn about should you dive into study technicals, the primary philosophical underpinning really starts with Dow theory. Dow theory was sort of created, if you will, over a span of about roughly the late 1890s into the early 1930s, and it started with Charles Dow. So it wasn't known as the Dow theory back then as he was doing this, but it was later in 1932, Robert Ray wrote a book called The Dow Theory. And in that book, what he did was he took all of the editorials that Charles Dow, who was one of the founding partners of Dow Jones and Company, which later went on to publish the Wall Street Journal. So in the Wall Street Journal, Charles Dow would write periodically an editorial on his philosophy on how markets actually work. So it had nothing to do with economics, had nothing to do with fundamentals or anything like that. Back then, it wasn't called technical analysis, but in essence, what it was an editorial on technical analysis, and it was how the market actually worked in reality. And so this is why he actually formed the 3 indices that he created, because he believed that if you could take the individual trends of all these hundreds and thousands of stocks that traded and aggregate them into an index, you could get a pretty good representation of the market's economic outlook. And that was a view that he held over 120 years ago. So this notion that he believed that the market held a sort of an economic wisdom, or like the wisdom of the crowds, which is something we talk a lot about today. There's a couple of books on that very topic, was something that drove Charles Dow over 120 years ago to actually formulate his indices. So he would write in the Wall Street Journal these editorials about how to interpret what's happening in the markets and in these indices. And of course, when Charles Dow died, William Peter Hamilton took over, continued to write the editorials in his place, and also wrote a book called The Stock Market Barometer, which is another very good book. And then, as I said, Robert Ray took all these editorials, put them into this book that then became known as the Dow Theory. And this is probably one of the best books that you can read in the markets today on this concept of Dow theory. So the theory itself has multiple facets to it, many different levels to the theory, but probably the one that's most well known is this idea that Charles Dow viewed that or surmised that the market trended in 3 different time frames. And so you would think about the long term, the medium term, and the short term. And in order to explain this concept, he used, as he was often want to do, he would use analogies. And so in this case here, he used the movement of the body of water around the earth, if you will, to represent these three timeframes of trends, and he referred to it as the tides, the waves, and the ripples. And that long-term trend, which he referred to as the primary trend, is the tide. So think about just that mass body of water sloshing around the surface of the earth. And these are the long-term trends. These are the trends that are driven by actual fundamentals. So this is the signal versus the noise. And because these are driven by fundamentals, these trends can last for years, if not decades. And most importantly, and I think that this is one of his great contributions actually in the Dow Theory, is this idea that these trends cannot be manipulated or altered. And so what that means is that, by way of example, we have, for example, Japan has been in a bear market for about 30 years, actually. And that is despite the fact that the Central Bank of Japan, which basically has a blank checkbook, has been doing everything it can to reignite a bull market in Japan. And right up to the point where today, I think the latest statistics indicate that the Japanese central bank owns roughly 70% of the public equities in Japan, vis-a-vis some ETF purchases and whatnot. So they're writing a lot of checks and spending a lot of money trying to ignite the bull spirits in Japan. And for 30 years, it's been unable to affect change. Why is that? It's because the fundamentals in Japan are so overwhelming and so one directional that even a central bank with a blank checkbook can't alter that trend. Another great example is today is we have a lot of bears on Tesla, and they've spilled a lot of digital ink on their thesis as to why Tesla should be go out of business and why the fundamentals are terrible and it's a fraud and all these other things. But it's been one of the best performing stocks of the past decade. And again, the reason is because, like it or not, the fundamentals are actually that powerful. So no matter how much money you have, no matter how successful you are as an investor, if you're short that stock, the fundamentals are going to run you right over in this time frame of trend, in this primary time frame. So if the fundamentals are good, that stock is going up or that market is going up. If the fundamentals are bad, that stock or market is going down. And I think that's a key premise, and it's why I operate primarily when I'm investing. I operate in this time frame because it's the time frame that I care most about, because it's driven by fundamentals. So that was probably one of his biggest contributions. Secondarily, we have what he called the secondary trend, and these are the waves. And so you think about the tides, and then on top of the tides, you have the waves crashing back and forth. These are driven by both fundamentals as well as emotion. So we have a combination of signal and noise here. And these can last for months, if not years. Importantly, these can be manipulated or altered for a period. Again, not permanently, but for a period. So if you have a large money manager who owns 10% of a company and wants to get out of that stock, that pressure conceivably could, and often does, pressure that stock lower for a period until that fund manager or a group of fund managers are trying to get out of that stock. But again, ultimately, that trend will resume in favor of the fundamental trend, because, again, that's what drives that long-term trend. And then lastly, you have these minor trends, or these ripples. So think about the droplets of water sort of flickering or flittering along the surface of the waves. These trends are driven almost entirely by emotional reactions to perceived fundamentals, right or wrong. So this is all noise, very manipulated. You'll see, like, a hedge fund might post something on Twitter or some sort of a short report on a stock, and instantaneously that stock can drop quite a bit. We saw it actually happen quite a bit with Tesla. So in that very short time frame, it's driven by noise. It is manipulable, or can be altered. But again, what ultimately prevails in the long run is that primary trend. So in a sense, Charles Dow was well ahead of his time, in the sense that he recognized that the trends are both random and efficient. And so the way he surmised it is that the prices become more random as your time horizon shrinks. So we're talking about these ripples and waves, and more noise and signal and volatility and things that, quite frankly, mean nothing. So that's why I don't look at intraday charts. Sometimes I will, from an execution standpoint, I'll look at the daily chart, but I'm just all too aware now, having done this for 30 years, that time frame of trend is all driven by noise. So I try not to spend too much time in that time frame, and I spend most of my time on these longer term trends, looking at weekly trends, monthly trends, even quarterly trends, because I know that's what's driven by fundamentals, right? So here's an interesting question. Were Paul Samuelson and Ben Graham, were they secretly Dow theorists, right? I asked this question because in 1948, 50 years after Charles Dow himself put forth the beginnings of his Dow theory, Paul Samuelson, in his textbook, The Economics, which is one of the great economics textbooks of our time, published in 1948, he wrote, "The ideal competitive market is characterized by an equilibrium that is constantly being disturbed, but is always in the process of reforming itself." And then this is my emphasis, "not unlike the surface of the ocean." That's almost verbatim what Charles Dow said 50 years before. So again, what I'm trying to draw here for you is this awareness of the similarity between how we think about what drives these long-term primary trends. It's almost the same underpinning sort of philosophy behind, what we do as trend followers and technicians and what others do as pure fundamental investors. It's all the same philosophy, if you will. And of course, Ben Graham is famous for many things, but one of his more famous quotes is that in the short run, the market is a voting machine, but in the long run, it is a weighing machine. These two comments together, that's Dow theory. Put those two things together and you have Dow theory that was put forth by the technical community 50 years before these two statements were made. So again, I'm not trying to distinguish the timing and emphasize the timing that we said it first or anything. What I'm really trying to do is just simply point out that the underpinning philosophies between the two of these ways of thinking are remarkably similar. So over the years, again, I've been doing this for 30 years. The past 20 years has been in the institutional space. So I've spent a lot of time. All of my time is spent as a technician. My first job was a technical analyst, and I've spent all of my time trying to help fundamentally minded investors just think differently about technicals and try to break down the walls that exist between the two communities. Because look, over the years, I've seen some pretty good fundamental investors become phenomenal fundamental investors, but more importantly, portfolio managers and risk managers when they listen to the market, right? So over the years, I've tried to break down that wall, and one of the ways I've done that is through the use of this formula. And what's most important about this formula is what you're looking at here is basically the three styles of investing. So you have price, which is technical analysis. You have EPS, growth estimates, which is F or growth. And then you have your estimate for your PE estimate, which is V or value. So you have price is equal to fundamentals times value. So this is a powerful formula, as simple as it is because what it demonstrates for you or to you is that we're all in this together. There's actually no right way to think about investing. There's no right strategy. I mean, if you look back in history, there have been incredible success stories in each point of this formula. Great momentum investors, great fundamental investors, and great value investors. So it's not the style of investing that actually is not the point, because they all work. What is more important is that we as investors, if all these styles work, then why is it so hard to succeed as an investor? I believe it's because we as investors engage in the wrong spot in this formula. It's more important for us to understand who we are and determine where we want to engage with this formula, so that then we can go forward and really kind of ride the ups and downs of the cycles with the confidence of our style. So the most important point here is that these three styles are all engaged in the same formula. So nobody makes money unless everybody makes money. It's that simple. So it's not that technicals is right and fundamentals are wrong, or the other way around. They're all correct. They all work together. And think about it that way when you think about technicals. How do I use technicals to make me a better fundamental investor? Not should I choose between one or the other. So we, in a very, I guess, efficient world, this formula would be fine just as it is. But what we also know is that there's often a significant gap between what theory would say a stock should be trading for and what reality actually reveals. And so that, to me, is a function of this other added element to this formula, which is behavioral bias, right? So B is the behavioral bias takes this formula to the power of emotions. So it's either this B can either be like 0.5, so you're effectively taking the square root of this formula in a bear market, So you have the fundamentals, but then you have the outlook for those fundamentals. And so in a bear market, everybody's estimates for fundamentals and what the stock is worth, the valuation, that all gets cut materially in a bear market, right? So the B becomes 0.5. When the trend is underway and everything seems to be somewhat normal and people understand what's happening, B is 1, right? But sometimes, like you could argue today, B can be 3, 4, or 5, and taking it to an exponential place where it just strikes us all that that what's happening in the marketplace is kind of crazy. So today we have companies that, yes, they have revenue growth on the top line of 30, 40, 50%, but the problem is every incremental dollar that they take in revenues, they lose more money. The free cash flow gets more and more negative. So in an ideal sort of like laboratory setting, that stock should be worth 0. The better it does, the worse it does, right? But today, I'm sure you're all familiar with these. We have stocks that are growing 20, 30% with negative free cash flow that gets worse and worse and worse, trading at 20 or 30 times revenues. Well, I mean, it makes no sense, right? That's the B. Because the B in a bull market, which is what we're in, gets people to look out 10, 20 years and say, well, I know it's not good now, but it's going to be a lot better. And so therefore, and in fact, it's going to be so good, I'm willing to pay 20 times revenues today. So that's the B that kind of wraps itself around this formula and makes things either crazy in a bull market or, I guess, frankly, crazy in a bear market as well. A couple other quick things to point out in this formula is, one is the difference in perspective. So if you come to the office every day operating on the right side of this formula, you're coming to the office with the perspective that the market's wrong. I have my fundamental view. I think the company's going to do X, Y, Z in growth, and I think it's worth 20 or 30 times earnings. That's my view, and it's very different from what's in the market. So I'm going to try to capture that spread. You're looking for instances where the market's wrong, and that's not wrong. I'm not criticizing that. That's just the mentality that you have to have operating on the right side of this formula. Conversely, if you come in like I do every day to the office and you're operating on the left side, I come to the office every day with the perception and understanding that the market is right. So those trends that are happening in the time frame that I care about are happening for fundamental reasons that the market in its collective wisdom has sniffed out. And so it's just a completely different mindset. And I think, again, that's the thing that we need to understand about ourselves before we engage with this formula. Where am I most likely to be able to continue to execute this strategy when things get hard and things get difficult? Because we all know every strategy has a drawdown, and we need to make sure that we're engaged in the right part of this formula so that we can navigate the ups and downs, importantly. And so the psychology and the mentality that you bring to the investment endeavor should really help you determine where you should engage in this formula. And then secondarily, and I think this is one of the great examples or demonstrations of the benefit and power of technical analysis, is that the degree of complexity on either side of this formula could not be more different. So on that F, if you click on that F, you open this massive decision tree of things that now need to be decided and analyzed. When we're talking about fundamentals, what are we talking about? Are we talking about revenue growth? Are we talking about earnings growth? In the revenue growth, is it units? Is it pricing, average selling price? And on the earnings growth, is it margin expansion? Is it a turnaround? Outside of the company, what's the competition doing? What's the government doing regulation-wise? Does this company have foreign exchange exposure? It's like literally a decision tree that you now need to address on that one company, right? And if you cover 20 or 30 companies, you now need to do that for 30 companies. So it's a very complex series of questions that you have to answer on every company. Then you click on the V, and now it's another Pandora's box. What are we doing here? Are we looking at price to sales, price to earnings? Are we looking at trailing? Are we looking at future? In the future, are we looking at 1 year? Are we looking at 10 years? Are we looking at relative valuations, relative to the company itself, relative to its comps? What are we looking at here, right? So you get the point. That whole side of the formula for one single company is very, very complex. Then you add in that it's 5,000 companies. And then you also have asset classes that have a bearing on oil, having a bearing on Exxon, and all these other things, and you get pictures that this is a very complex world on the right side of this formula. Conversely, when you get to the left side and you click on that P, what you get is P, right? Price. It never changes. Price is always price. That's the power of trend following. every single day, at any time you want, you can get put this in the proper context of the trend that it's in. You can get the market's assessment of what all that complexity on the right side of the formula means in that moment. So if you can find a stock that's trending in the time frame that matters, which we talked about earlier, that's telling you that in the market's wisdom, in the wisdom of that crowd, has taken all of that complexity of that one company, and then the 5,000 companies and all the other millions of data points that hit the market in any given day, and has in one simple verdict gives you this price. And again, that's the power of technical analysis to make such a complex world so simple, right? And again, I'm not saying one is right and one is wrong, but you get the picture. Put these two things together, and now you're really talking about changing your process in a way that can really make a difference. So in the end, technicians agree that that there's actually nothing more important than fundamentals, right? Without good fundamentals, there are no good price trends, period, stop. If you have bad fundamentals, it's a bad price trend, right? So there's no disconnect in that philosophy between technicians and fundamental investors. We're joined at the hip. We agree 100%. It's just that we as technicians and we as trend followers have hired the market to be our fundamental analysts. Why? Well, because the market's proven itself to be a pretty good fundamental analyst. That's why it's so hard to beat. So what we do as trend followers in trying to capture our philosophy, which is very similar to the fundamental world, is that we just have a different process. Our process is to assume the market's right, not that it's wrong, and to just follow the trend, right? And I'm not saying it's easy. Trend following has its own ups and downs and challenges for sure, but this is where we kind of begin to differ, is in our process. An important point is that no matter who you are, on a day you buy a stock, if you could be buying a stock because of a quant model, a valuation model, a hot tip, somebody told you that gave you some insider information, whatever the reason is that you bought, fundamental reasons, growth, trend following, technical, macro, asset allocation, whatever the reason is, you bought that stock on that day. From that point forward, you're a trend follower, because you now need that stock to begin trending upward, and the sooner the better. So I have a diagram to demonstrate what I mean by that, which I hope will kind of bring this all together for you. But let's take a pause and just ask one more question here. When you buy or sell a security, do you look at a price chart before you buy or sell a security? Yes or no? I love that. That's actually the highest response I've ever seen. So we have a relatively chart-friendly crowd, and we either have a lot of people who know what they're doing looking at charts, or who don't know what they're doing looking at charts. But nonetheless, we have a lot of folks that really what I would say are doing the right thing, looking at the chart before they make a decision. So congratulations to you all. Let's move on here. In the end, we are all trend followers. So if we, ideally, if you're looking at a trend, it's kind of up and to the right if you're long, or it's down and to the right if you're short, right? So it's kind of got a directional movement to it. But if you detrend that trend and you just put it on a sine wave like this, right? Right in here would be your average. So call it the 200-day average. And of course, anything up here would be an uptrend with various degrees of momentum, and anything down here would be a downtrend. So again, as I said earlier, no matter who you are as an investor, any walk of life, any time frame, any region, any asset class, it does not matter. If this is what the life cycle of trend looks like, to my knowledge, there's not a person on this planet who is trying to buy trends outside of these two segments. We're all trying to capture that portion of trend. In other words, nobody's coming to the office specifically trying to buy stocks at 20 so that they can then go to 10 or go to 5, right? We're all trying to buy the same exact segment of trend, everybody, right? It just turns out that right in through here is where the strong and improving fundamentals exist. As I talked to you earlier about Dow Theory, this is a pretty good diagram demonstrating the notion that the trends that we're really trying to capture are driven by strong and improving fundamentals. And of course, over here, we have poor fundamentals. And up here, we have weakening fundamentals. So the idea is we're all trying to capture good fundamentals. It's just a matter of how do we do that as trend followers? How do we do it as value managers? And what ends up being the case is that we have this cycle of trend, and where we differ is just simply where we engage. So a value manager will start to buy here, right? As a function of their valuation framework. So, you know, stocks at 12 times earnings, it's at the bottom end of its 10-year range. So therefore I want to buy the stock, and then the stock goes lower, either because the earnings went lower and the PE stayed the same, or the earnings stayed the same and the PE went down. But you know, if you thought it was cheap at 12, you got to really love it at 10. So you just continue to buy it as the stock gets cheaper. And again, that's not a criticism. We all know that value investing over time is one of the best ways that you can invest. It's suffering a bit now because of the deflationary impulse that sort of has made its way around the world, probably starting in Japan in the late 80s. But we know value investing works, and this is how it's done: buying cheap stocks, right? Buying stocks cheaply. As a result of their valuation framework, we also find that value managers begin to sell here, right? It all works. So buy low, sell high. That's a great way to invest. In the end, the way a value manager can assess his experience is that he begins buying early, and in so doing, it exposes them to large losses, right? Stocks continue to go lower after they buy. They begin selling early because of the valuation framework. And so as a consequence of that, they forego large gains. The end result is that they end up with a negative skew to their return distribution, okay? On the other side, operating in the same exact phase or cycle of trend, we have trend followers. And here is where we start to buy. And we start to sell here. So our experience as trend followers is quite the opposite. We begin buying late. We never buy the low. It's not even something we try to do. I could not care less about buying the low, just because I can never tell when the trend is going to be over. So I don't even put forward that effort. We begin selling late, meaning we never sell the high. What we're trying to do is on that trend that everybody's trying to capture. We are just trying to capture as much of it as possible without forecast as to when it's going to end, right? So as a result of that effort, we end up with a positive skew to our return distribution. So again, neither one of these is right or wrong. It's just different, right? You just got to match yourself to the style that we're talking about. The point is that the changes in fundamentals. So we have this curve with different degrees of valuation all along the curve, and of course, different degrees of trend along the curve. The point is that changes in fundamentals is what is the catalyst that actually unlocks those cheap stocks or those expensive stocks. It's the change in fundamentals, the improvement is what makes a cheap stock go up. And the change in the fundamentals or the deterioration in fundamentals is what makes an expensive stock go down. It's not the valuation that makes it happen. It's the actual inflection in fundamentals. And what I'm trying to, for 30 years, I've been trying to make the case is that the trend change in the time frame that matters. Again, it's not on hourly charts and 15-minute charts, but in meaningful time frames of trend, that's the trend change is the signal, right? So let's make this a little more practical. The inviolable rules of trend following. So what do I mean by that? So here's a chart of a semiconductor company, and I love this quote. This is from Richard Kraut's Aristotle's Ethics. I have the link there if you want to follow up on this. But what he says in there is that although Aristotle holds that ethics cannot be reduced to a system of rules, however complex, he insists that some rules are inviolable. So, you know, this applies to life, but it also applies to investing as well. So as I demonstrated, investing is incredibly complex over there on the right side of the formula. But there are some things on the left side of the formula that are rules that truly are inviolable. So in the course of a cycle, a stock can go up or down for any number of fundamental reasons, right? It could be, as we said, it could be revenue growth, it could be a turnaround, it could be margin expansion because of cost cutting, whatever it is. A lot of things can make a stock go from 5 to 40. And more importantly, is that those fundamental drivers can change from cycle to cycle. And in fact, they often do. But from a technical perspective, there are boxes that must be checked every single time, every single cycle, no matter what the fundamental drivers are. That's a powerful statement. There are no guarantees in this business, right? But I'm about to give you one guarantee. You cannot other than situations where the stock just gaps up or down 20 or 30%, which is something that all styles are exposed to. It's not just a phenomenon of technical analysis. Outside of that scenario, these four things must happen, and I refer to them as the checklist of trend change. So if I'm thinking that this stock is overvalued, and I'm thinking that it's has risk of going from 40 down to some 20 or 15 or whatever, and I'm trying to dovetail that fundamental observation with trend following, what I would do is I would avoid shorting this stock until it broke the trend. So this stock, you just look at this visually, this stock can never, in the course of this uptrend, can never go down unless it breaks its trend. It has to cross the trend line, absolutely positively must cross that trend line before it actually can go down. So we've checked that first box. Secondarily, every uptrend is a series of higher lows. If you can identify the last higher low, in order for this stock to go down, it has to go through that higher low. So if the stock is going to go from 40 to 10, it has to go past 25 or 30 first. It must do that, right? That's a guarantee. It's inviolable. Third, the short-term moving average must cross the long-term moving average. These are mathematical concepts. They're linked to each other. A stock cannot go from 35 to 10 unless these averages cross. And then finally, that long-term average has to turn down. If we're looking at a 200-day average of price, that 200-day average cannot keep going up while the price is going down. So these four things absolutely, positively must happen. And once you've been able to check all four of these boxes, here's the concept. This is where trend following can come into play. This is where risk management from trend following can really come in and sort of save your bacon, if you will. Sell, no more buying. And you don't want to buy this stock until you can start checking boxes in the other direction. And then you can stick with that idea until you can start checking boxes in the other direction once again. Okay, that's when I'm investing, I do follow the fundamentals. I'll listen to earnings calls. I have a bunch of ranking systems that rank fundamentals, the growth, the quality of the company, management assessment, all ESG, all these different things. I pay attention to all of them, but I don't make a single decision unless I can map it to this diagram that I'm showing you here. So no matter how much I like a company, if it's in a downtrend, I wait. And that's what I've taught institutional investors over the years. And I've seen some great, as I said earlier, some really good institutional money managers become fantastic portfolio managers and risk managers by just following something as simple as what I just showed you. Okay, before we move on, we're going to start talking about risk now. Before we do that, let's ask you a risk question. What price action forces you to rethink your conviction in your trade? So how much does a stock have to go down before it gets you to start thinking that maybe you're wrong? This will be interesting to see what the answers are in light of the first two questions. I'm hoping there's some logic here. Yeah, I'm surprised to see so many more than 20%. I thought we would have seen some risk management here, but the biggest category is 10 to 15. That's typically my window where I'm finding myself getting stopped out of trade. So very, very interesting. I like to see that very few of you said 5 to 10, which means that you're not focused too much in that minor ripple, if you will, that noise-driven time frame. So that's good to see. All right, great. Okay, so let's talk about risk management. This data set, I think many of you have probably seen in one form or another. If you haven't, this is data that comes from Professor Ken French. Fantastic website. Just Google Professor Ken French and you'll be taken to his website. And he has all kinds of data series all the way back to the early 1900s where you can backtest valuation, growth, momentum, all these different studies, and it's all available for free. So highly recommend it if you're interested in going there. But this one here is momentum. And we're going back to 1927. And all we're doing is we're just taking the stocks in the market and we're deciling those stocks according to their previous 12 months performance. So the top decile consists of the top decile of prior 12-month performance. That's considered the top decile. And of course, the bottom decile are the stocks that did the worst over the past 12 months. And all we're doing is every month, we're going to run this study, run this calculation. And if there's anything that's in that top decile from the prior month that fell out, we just sell it. And obviously, by definition, something will come up and we just up into that decile and we just buy it. So, and we just repeat that process each month. And so this is what the performance looks like over time if all you do is concentrate on owning the best performers. And this is what it looks like if all you do is concentrate on owning the worst performers. So what I try to encourage PMs and portfolio managers and analysts to think about is if you can focus your fundamental energies in the top 3 deciles, there's 2 major benefits there. One, you just immediately scaled your process. You just eliminated 70% of the market. So that's a huge benefit. And if you're a pure fundamental manager, you know exactly what I'm talking about. It's impossible to do analysis on every company, but here's one way to just eliminate 70% of the market right away for you. So that's one. And two, it's this idea that you know, we all know this, investing is about getting the odds in your favor as much as possible. Here's a diagram that shows you one clear-cut way of doing that. To get the odds in your favor behind every stock you pick, try to pick your stocks from the top 3 deciles and try to avoid the stocks in the bottom 3 deciles. So the way that I say it is fish where the fish are, right? Don't try to fish in that bottom decile. I know there's a lot of temptation to do that, and maybe you'll catch a huge fish. I'm not saying you can't buy stocks in that bottom decile that don't do well over the next year. It's absolutely the case. But as an ongoing day-to-day effort, you're swimming upstream, right? Fish in that top 3 deciles. That's where all the fish are, right? And that's where you're going to have a greater odds of catching fish. Therefore, because that's where they are. So a little more on managing your risk and the importance of digging small holes when you're wrong. What do you do as a fundamental manager when you're wrong, right? First of all, how do you even know you're wrong? One way to do that, again, is to dovetail these styles together, bring fundamentals and technicals together, and use the technicals to help you determine when you're wrong, which we talked about with that checklist of trend change. But this slide is all about showing you why it's that important, right? So I'm sure, again, we've seen some iteration of this before, but it's so important. I think it's just, we really need to kind of go through it real quickly here. But if you raise money from a client and in your first year or your first couple of years, you're down 50%. We all know that from there, you now have to double your client's money to get it back to where you started, right? And that's assuming that the client is even still there. You may not even get the chance to restore that client back to where they were because they more than likely would take the assets away from you. So the importance of digging small holes cannot be overstated. It's one of the most important things to think about when you're managing a portfolio is do not lose a lot of money, right? Another fallacy is this notion that a stock can't go much lower. So the stock is already down 90%. You know, it's down there in the bottom decile. So I'm thinking of buying the stock. I mean, it's going to go down another 5%. I mean, I can swing that. That's not a big deal. What we lose sight of is that it's not 5%. It's another 50%. So no matter how far a stock has gone down, it can always go down 100% from the day you purchase it. So if you're making a practice of buying stocks that are down a lot, that are still in a downtrend, then you know, this is the fallacy that you can potentially find yourself getting caught up in. It's gone down so much, it can't go down much more, but it can actually go down a lot more, right? So here's one example of how important it is to avoid these big losses. So this is just a track record that I made up. It's not a real track record, but it's somewhat comparable to Stan Druckenmiller, who's one of the great fund managers and hedge fund managers of our day. You know, it's basically 10 years of performance, never a down year, averaging 20 to 30% each year, ends up with a 10-year compound growth rate of 23%. Phenomenal, right? But what if the same investor had to learn some lessons in that first year and didn't respect risk when he first started when she first started, and instead lost 50% of the portfolio and now has to rebuild from there? In that rebuilding process from year 2 to year 10, had the same exact track record. So in any other world, I mean, that's phenomenal. That 9-year run is an incredible track record. But the net effect or the impact of that really bad year where the risk management went out the window is that it took 4 to 5 years to get the client's money back, assuming the client stayed with you at all. And then most importantly, that 10-year record is almost cut in half as a function of poor risk management. So there's this concept of expectancy. And again, I don't care who you are as an investor. You could be Warren Buffett. Nobody escapes this formula. Everybody has to face this formula. So if you're not aware of it, that's a problem. But if you are aware and you disagree with it, tough, right? Everybody has to contend with this formula. And it's simply this. If you lose 60% of the time, which sounds like a lot, but in actuality, over a full cycle, that's actually a pretty decent portfolio manager. 50% is really good. 60%, if you're right half the time, you're very good. And if you're right 60% of the time, that's top decile. So 60% is definitely manageable. And the reason it's manageable is because if you're right, when you're right, your gain is 2 to 3 times more than when you lose. You do that math, which I've done in this formula here. You can see that it has a positive expectancy. So even though you're wrong 60% of the time, what keeps you at the table, even though you're wrong the majority of the time, is losing a little every time. Don't lose a lot of money. Don't get caught up in that fallacy of it's already gone down 90%. So I think it's safe to buy, quote unquote safe. So this is a formula that I highly recommend. If you don't do this already, take the history of your trading and actually run it through this formula. That process alone will give you so much feedback about your process that I think it's a good starting point to really get some direction as to where you really need to take a look at your investment process from a risk management perspective. Know what your average win is, know what your average loss is, and how often you're right or wrong. That's a very good, important place to start this whole discussion with yourself. George Soros, worked with, or Stan Druckenmiller worked with George Soros, 2 of the great managers of our time, said it himself. It's not whether you're right or wrong that's important, but how much you make when you're right and how much you lose when you're wrong. And I just say, if it's good enough for George, it's good enough for me. So really important concepts here for you to think about. Okay, so let's move on to some examples. So here's an example of how a fundamentally minded investor can lean on these technical tools that we just talked about, that trend lit, the checklist of trend change and these other risk management tools, to bring these 2 things together, right? To maximize the value of your best ideas. So here's Home Depot. During this period, this 3-year run from 1990 to 1993, of course, the stock went vertical, massively outperforming the market. And as you can well imagine, we see the formula here, price went up a lot. So we don't have to think too much about it. Just look at the right side of that formula. Something good had to have happened over there, right? Ideally, a multiple of things happened that were good over there, but something good had to happen. And when we look at the actual fundamental performance, we can see that the revenues went up 186%, the EBITDA went up 210%, margins expanded 100 basis points, and the valuation went from 1-time sales to 4-time sales, and the PE ratio went from 28 to 85. So in this formula, we can see everything's working together, but in particular, what we see is the B part, right? So we got the fundamentals right. We got the valuation. Maybe we thought it was worth 30 times earnings, but along the way, that stock went from 30 times earnings to 40 times earnings to 50 to 60 to 80 times earnings, right? So along the way, if you're a valuation focused investor, it's conceivable that you would have sold when it went to some crazy PE ratio like 50, right? And it actually went to 85, right? That's the B in this formula. That's when things can get kind of crazy, right? So, but that's also the reality of investing. Okay, so then the stock went sideways for about 4 years and quite, massively, consistently underperformed the market. So again, just reflecting back on that formula, price went down. It's unavoidable. Something happened on the right side of that formula, right? This is the challenge. We would assume that it's some combination of everything, but in reality, what happened was the revenues went up 240%. EBITDA went up 250%. Margins expanded again 100 basis points, or margins expanded again, not 100 basis points, but they expanded. It was the valuation. The valuation returned to 1-time sales, and the PE ratio returned to 28 times earnings. So there's the challenge. The fundamentals are great. So if you're just a pure fundamental investor who doesn't really think too much about valuation, at one point, the market on any given day wakes up and now all of a sudden valuation matters, right? So here's the challenge is how do you navigate those disconnects between when valuation matters and when it doesn't matter? By using that checklist of trend change, which I showed you earlier, you can see how this stock went through that process and told you when the market cared about valuation. And then of course we now know the stock went on another tear, outperformed, and look what happened with the fundamentals continued just as strong. Margins expanded again 100 basis points, and look what happened to the valuation. B kicked in again and brought us back to where we were, 4.5 times revenue and 86 times earnings, if you can believe it. So the idea is that since it's impossible to know when valuation will matter, I just argue then, why not listen to the market and let the trend tell you when it matters? And I think this is a good example of how it all can come together. So another way that this is how I've really also helped to try to encourage fundamental investors to think about leaning on the message of the market, much like Charles Dow suggested over 120 years ago, is to think about the information you can glean from the market just by following it technically. So we know that top down, we have questions that we have to address, like what kind of environment are we in? Is it bullish, bearish, or mixed? Which sectors should I favor? Which ones should I avoid? Which factors are leading? Which ones are lagging? These are important questions. And the reason they're important is because the majority of what happens to a stock is determined by the trends that are taking place in the market, in the sector that stock is in. Depending on the environment you're in, 50 to 70% of the outcome for an individual stock on average is driven by those two things. What's the market doing and what's the sector doing? So I think from a research and a scaling perspective, technical analysis can really help in that regard. So here's looking at the major sectors of the market. You can do something as simple as rank the sectors from a momentum perspective, right? And from this, we can get some pretty important information. So here's the best performing sectors at the top and the worst performing sectors at the bottom. One observation we can make is look in the middle, and we can see that half the groups are down on the year and half the groups are up on the year. That's a very bifurcated market. So this table is a little bit dated, although it's still probably pretty accurate. The market's still very bifurcated. Bifurcation, as we all know in the fundamental space, is another way of saying alpha opportunity, right? When there's a lot of stuff going on beneath the surface, there's a lot of opportunity for alpha, and by monitoring the market like this, you can get that type of information. So in 2014 and 15, when we did this process, again, everything was ranked best to worst, but even the worst group had a very high rate of change. That's telling you that you're in a very explosive bull market. In 2008, again, you rank the groups, it's green to red, because there's always a best and there's always a worst. But in 2008, every one of those groups had a negative return. That told you something too. So by just simply ranking the market and seeing what's actually what's driving those ranks gives you a very good indication of what's actually happening from a sort of a macro top-down perspective. Another way to think about it too is, so as a portfolio manager, is that you'll want to be overweight these sectors and underweight these sectors. Again, scaling your process. We've just determined how we can spend the majority of our time focusing on the best performing groups. But we can also look at over here, we have ranks for growth and profits and valuation. And what we can see here is if you look all the way over to the right, all of the best performing groups are expensive and most of them have high profitability. So what we're looking at here is an environment that's very bifurcated, but favors expensive profitability, right? So this is something that not only you can make an observation like that in a snapshot sense, like I'm doing here, but if you track this month by month, you'll see the changes and you'll know when the market's changing and when the environment's changing. And all of this, again, is by leaning on these technical principles. So if we were to take that best performing group, which was we're actually looking at the second best performing group here, which is semiconductors, right? How do we use this information? So we've taken the big picture, and now we're drilling down to the sector level, and we're just looking at inside the sector. We've determined that we want to own the sector because it's one of the best ranked sectors. So from a generalist PM perspective, there's some observations that you can get from this information, right? First and foremost, the worst ranked stock in this group is a 68 relative to the market. So that tells us that the majority of stocks in this group are outperforming the market. and again, we're ranking these stocks from a technical perspective in a time frame that matters. This time frame I'm talking about is linked to fundamentals. So as a fundamentally minded PM, I know that in the time frame I care about, almost every single stock in this group is outperforming the market. As a PM, I want to be overweight this group. There's no question in my mind, right? Now, what if I'm an analyst, as a generalist, as a sector specialist, if you will, and I'm fortunate enough to be covering semiconductors. What I can say here is that I would turn around and rank these stocks not relative to the market, but I would rank them relative to my coverage. And you'll always have a best and worst. So even though every one of these stocks is outperforming the market, which is good for a generalist PM to know, inside of my coverage, I still have to figure out which ones to have my ones on and which ones to have my sells on, my buys and my sells. And a process like this does a very good job of helping you do that. And then if you look at the worst performing group, how can we use this information? How can we use this technical ranking process to glean information about the fundamental picture here? Well, as a generalist PM, I can look at this column here, and what I can see is that the best ranked energy stock has a rank of 78. And if I look at the return, it's a negative 28. So every stock in this group has a negative momentum over the past year. So as a generalist PM, I know for sure I want to be underweight. And I know that if I rank this every single week or every single month, I'll be able to see the evolution of trend change, that checklist of trend change, and I'll know when it's time to, one stock at a time, start to get involved in energy. We may be seeing that now, actually. This, again, as I said, this table is not updated. So I want to be underweight this group, the sector, as a generalist PM. But as a sector analyst, if I have the misfortune of having to follow energy as a sector analyst, I still need to guide and help my generalist PMs. Number one, help them confirm that they should be underweight. But I can still rank all these stocks relative to my coverage, and I'm always going to have a best, and I'm always going to have a worst. So I can use this information to, if a PM wants to have one or two stocks in their portfolio in the energy space, I can guide them to my best ranked stocks in this space. And so again, it's the whole notion is not about what's the right way to do this. Is it technical or is it fundamental? It's about how can I, as a PM in this very competitive space, trying to beat the market, which has been demonstrably difficult to do over time, what tools do I have to bear, that I can bring to bear upon this endeavor? And the best PMs I've ever seen in my life have been the ones that lean on both. The ones that have a fundamental core philosophical understanding, but then listen to the message of the market. And what I hope I've demonstrated here are some A, good reasons to do that, and B, some very straightforward, actionable ways that you can put that to work starting today. So one of the questions I get a lot is, are there any books that you'd recommend? Here's a few that I would definitely recommend. And I think with that, we can probably turn it over to some Q&A.
Thank you for that. Thank you for your prepared remarks. I know we are already hitting the 1 o'clock mark. I want to get to your questions and some of mine as well. So we'll go a little bit over if people are able to stick around for that. As a reminder, submit your questions in the Q&A button and not through the chat function. Until some questions roll in, I'm going to ask a couple of my own, if that's all right. You, on slide 15, we're talking about technical analysis as a fundamental PM. Are there certain time periods to which we are benchmarked that would make it appropriate for using the technical analysis or not appropriate? So for instance, if I am looking at a track record that's 5-year or 10-year or 3-year, are there certain time periods whereby that technical analysis component would be more or less important?
Yeah, that's a really good question. That actually hits on, when I do technical analysis, I use momentum as an input. I don't use it as an exclusive driver. So what we talked about here was pretty much just momentum, which is one subcategory of technical analysis. And it's like, it was, as you can tell, it was a challenge getting it all in the time that we had. But one of the things that you need to know about momentum is that the sweet spot of momentum is anywhere from like 6 to 12 months. stocks that demonstrate momentum in that time frame tend to demonstrate momentum the next month and continue to demonstrate momentum. When you get outside of that window of time, when you start talking about 3 and 5 year momentum, that time frame of momentum has a high tendency of mean reversion. So if something's done really well for 5 years, that's when it's kind of like getting a little long in the tooth and has a tendency to mean revert. Price action also has a very high tendency to mean revert in the short term as well. So if you're up a lot in a given month, even though it may be like a top performing stock in that 6 to 12 month period, if it's up a lot in a given month, there's a tendency for it to mean revert as well. So if you're going to use momentum as an input, you're best off focusing in that 6 to 12 month time period and just be mindful that it tends to mean revert outside of that window.
Got it. Thank you. Now there are a couple of questions rolling in. I want to get to those before I go back to more of my own. First of all, you know what? Can we share the slides with those interested? We're having people roll questions through about content on your slides and also your reading list.
Absolutely. That's all. Okay. That'll all be available for sure.
Wonderful. Going to your French data, a couple slides back, does the French data in best/worst performers include transaction costs and taxes? And would these costs kill excess returns?
So that's a very good question. It's a question we get all the time, and if anything, it's a pushback against any model, but in particular momentum, because nobody wants to see this actually work. So they'll really push back on things like turnover and slippage and all these other things. So I can only tell you as a institutional professional trend following momentum investor for 20 years, you know, our performance is what it is. I mean, we performed very well, and our turnover changed from anywhere from, some of you may want to block your ears when I say this, but our turnover was anywhere from 200 to 800%, depending on the environment. So like in 2008, we went to cash as the market started to roll over. Obviously, that's 100% turnover in about 2 weeks, right? So in that kind of environment, our turnover is going to be very high. 2013 to 14, when as I said earlier, when every stock that had even the stocks in the bottom deciles of performance, even in those deciles, the performance was still quite strong. In an environment like that, our turnover is going to be very low. It's like it was averaged, well, again, very low, averaged around 200% for us. So I absolutely would have to say that the returns that you see in the screen would absolutely be depressed relative to what you see there. But in a real time application of trend following and momentum, I can only tell you that our experience was what it was, which was very good. And there's many people you can research on the web that have had phenomenal returns over the years, which is reality. Great question.
Are there widely used forms of technical analysis that you think have very little value? And sub-question, what are your favorite technical strategies?
So I could probably answer that question rather than saying what I find little value in, by really just answering what I do use, which by implication suggests that I find less value in the other things. In what I showed you in that checklist of trend change, I just think, if you're trying to build a strategy, the most important thing is that you can't have a lot of assumptions embedded in your strategy. It has to be replicable. It has to stand the test of time. And so therefore, the simpler you can make it based on these inviolable rules, the better off you are. So I use things like trend lines, moving averages, in relative performance and momentum. Those are pretty much, that's my input to my process. Beyond that, it's not a function of whether I find value in the other parts of it. So when you look at the CMT curriculum, I mean, it's a 3-year program of basically examinations on lots and lots of strategies and techniques and indicators and things like that, all of which are back testable. So there are some indicators that, like RSI or something, which is simple, it's a momentum indicator that back tests very well. You can find all kinds of research on that on the web. I don't use it, not because it's not valuable and not because it doesn't work. It's not in my time frame of execution. Because I'm focused so much on the fundamental side and I'm trying to really engage with that long-term trend. these are the tools that I use that really keep me best aligned with that time frame. But outside of that, the body of knowledge within the technical community is expansive, back testable, and adds value to anybody that wants to use it, as long as they're mindful of that they're properly matching the time frame to what the tool is intended to help.
Another question here. Given the extraordinary support stocks have received from central banks, some of the historically bearish moving average indicators, such as a death cross, have actually marked bottoms rather than serving as solid bearish indicators. How has this affected your views on recognizing trend change, if at all?
Fantastic question. Yeah, a dirty little secret. And again, this is not something that's that you know, you can backtest this statement. But I've in my early years, I really listened quite a bit to that whole death cross, and the golden cross is the opposite, with the 50-day crosses above. But in actuality, if you're in the, you have to know what regime you're in, which I showed you that table that ranks all the different sectors. And if you can rank all the sectors, which will always, there'll always be a best one, there'll always be a worse one. And if you look at the worst one and it's up, you know that you're in a bull market, right? So if you have all these charts that are trending, but they're underperforming the market, that tells you that the rest of the market looks really strong. And so in that environment, when you get a quote unquote death cross, it's a buy signal. I actually refer to it as the mother of all buy signals. So it's quite opposite of what most people will tell you. Of course, in 2008, when the environment was very different and you got a death cross, you better act on it, right? So it's definitely, it's about implementing these tools, which are incredibly powerful. They're simple, which begets their power. But to have a level of regime awareness is really what matters. So sometimes a death cross matters, and some other times it's actually the opposite of what most people would tell you. And it's all about understanding the regime you're in, much of which is a question that can be answered vis-a-vis using these technical tools.
Similar question, how has technical analysis changed as programmatic trading has increased over the last decade? And then if you want to work in something about ETFs and other types of investment strategies changing the nature of technical analysis as well, that would be good.
So that's a great question. And I would say that where high frequency trading and programmatic trading has had its greatest impact. Remember, I talked about the 3 timeframes of trend. We had the tide, the waves, and the ripples, the long term, medium term, and short term. Is in the medium term and in the short term. That's where it's had the bulk of its effect. So for me, as a trend follower, trying to execute in that fundamental time frame, it's had no effect on me whatsoever. I haven't changed my tools at all. Trend lines are trend lines, no matter who's buying it. If it's a systematic investor or a fundamental investor, it doesn't matter. In my time frame, it doesn't matter. But in that medium term, but in particular that short term, things have gotten pretty crazy. A good example is, I think it was 2010, we had that flash crash. And that was basically when all these systematic quantitative investors pressed the sell button at the same time, is one explanation. And we instantly crashed. And we had stocks like, we actually had the low volatility ETF went down. If you weren't in the markets at the time, the low volatility ETF went down 50%. That's 50 in about 10 minutes, right? So that's a function of the type of investor that's in the market today. And there was also some said that there was a fat finger trade and somebody pushed the wrong button or whatever. But whatever it is, the systematic investing, high frequency trading can really cause a lot more volatility in that short term window. So it has, if you're in there day trading, it can really ruin you, quite frankly. But for me, where I'm purposefully executing in the fundamental time frame, it has less effect. And there was another good question. There was a follow up to that. So ETFs. So back in the day when I first got into business, there was really no such thing as an ETF. So if I'm slowly getting more bullish on the market and I want to increase my cyclical exposure, then I would go into the market and I would buy General Electric. I would buy a bank, Bank of America or something. I would increase the cyclicality of my portfolio. And it's that allocation to one stock at a time that caused the breadth numbers to really be meaningful, right? So as you saw breadth start to turn higher, you knew that institutional investors were starting to allocate to these cyclical sectors. Today, if I'm starting to get more, like just recently, I was getting more bullish on energy, and I really, energy was in such a bad spot, which I showed you on that chart, on that table. But I had reason to, in my sort of inflections of this technical, the checklist to trend change, I started to see enough change that I wanted to engage with energy, but I didn't think it was strong enough or clear enough that I didn't want to necessarily stock pick. So I bought the XOP instead. That's different. So back in the day, if there was no XOP, I'd have to sit down and say, okay, I want to buy these 4 stocks. And so it really had a distinct impact on the breadth of the market. Today, I just bought, I don't know how many stocks are in the XOP, but it's call it 20 or 30. I literally bought 30 stocks in 2 seconds, which has a materially different impact on breadth. So I think of all the technical measures that have probably really been changed by this, the ETF business has been, breadth has been really changed quite a bit. It's not that it's not, there's no value, but you got to really be mindful of what you're looking at.
Something I'm hearing a lot of chatter about, interest from people, Tesla, etc. So to what extent has increased usage of technical analysis become a self-fulfilling prophecy? Patterns thought to imply downside are sold and vice versa. Is this part of the reason for the FANG stocks and Tesla to have increased to unparalleled multiples? And will this effect also be evident on the downside? And you may or may not want to comment on Robinhood type favorite stocks as well.
Yeah.
Up to you.
Yeah. So, technical analysis as a style of investing has been around since, I don't know if Tyler or Bill are on, can comment, but I think candlesticks were invented in the 1600s or the 1700s in Japan. So that the idea of charting price has been around forever. And the idea is that when price goes through its cycle of trend, and when price begins to turn higher, that's momentum, that's technical analysis, that's it's the same indications at the turn as, technical tells you the same thing at a turn as it tells you at once trends get up and going. The idea is that even when things are turning at the bottom and technicals are telling you to buy, people still don't want to buy it because of behavioral biases, which I talked about. That's that the B in the formula is still a 0.5, and it's kind of reining in people's expectations. So in that moment, technicals matter as much as they do in any other part of the cycle, but nobody's really following fundamentals. Nobody believes in the fundamentals. Nobody believes in the valuation. They see the price turn, but they don't believe in it. So none of that is really enough evidence for investors to really latch onto it. But what we find in time is as the stocks continue to go higher, one of the thing that changes minds most is price change, right? Because the higher a price goes, the more people change their minds about what's going on. It's like, oh, maybe the fundamentals are getting better. Maybe it's worth that valuation, whatever it is. And then, so those things all compound on each other. So it's not just people become technicians as the market moves higher. But there's something to be said for the idea that as the cycle progresses, in the beginning, they don't believe anything. In the middle, they believe fundamentals and they believe valuation, and that's pretty much brought upon them by the fact that price is changing. At the end, they're willing to believe anything, price included, right? And that's where we are today. As I said earlier, I mean, we have companies that are trading at 20 times revenues, and for every revenue dollar they bring in, they lose more money, right? So, I don't know what to tell you about that, but the thing with trend following and technical analysis, and unfortunately I have some real-time data to support this idea, is that it's the style that most people adopt, but they shouldn't, because they don't have the proper mindset as to what it all means. So, and they tend to adopt it at the end of a cycle. So yes, there's something to be said for the idea that at certain phases of the cycle, technical analysis can be self-fulfilling, but it can be self-fulfilling in a very good way, because at that stage of the game, that's when you commit money. I mean, in the last bubble, I wasn't there at the time, but my former boss at Wellington, Frank Texera, who I think is one of the great technicians of our generation, he was managing a fund, and in 1999, he was up 508%. So when technicals become self-fulfilling, don't be shy about it. That's when you can really make a career, and he certainly did. And then when everything rolled over in 2000 and the market fell apart, he was up 25% that year by watching that checklist to trend change. So yes, there's no question that charts can at some point in the cycle become self-fulfilling. That's at the end, but those same patterns, you can take them down at the beginning of the cycle and nobody believes them. right? So it's all I can tell you is technicals have been around for 300-400 years. They're as valuable as they'll ever be today, and they'll continue to be valuable. It's probably worth being aware of when some of these things can be self-fulfilling, but it's not a reason to pay attention to it versus not.
And I'm going to give you one more question for those in the audience who work at a long-term fundamental focused type shop. Where would you say is it appropriate or easiest to insert technical analysis and technical themes into a fundamental shop like that, the analyst level, the PM level? And what have you seen in the realm of what works doing that?
So I can give you some real life examples of this. So I have a colleague who who is truly one of the best stock pickers, one of the best portfolio managers I've ever known, ever seen, has the CMT, and spends half his time looking at charts, right? What's he doing? Why is he doing that? Because he's trying to get the message of the market. He's trying to find, and I don't mean all these charts that are going up. I'm talking about charts that are inflecting, looking for that, because he knows in his understanding through the CMT curriculum and following Dow Theory and technicals generally, that that's happening for a reason. And that inflection is on the weekly chart, the monthly chart, the quarterly chart, right? Not on the hourly chart. So here's a fundamental investor at a very fundamental shop who spends almost half his time looking for those inflections. And he's one of the best performing portfolio managers I've ever known. So in his process, he has a CMT. I don't know, he doesn't make it known that that's part of his process, right? So there's different ways you can do this. I have another contact, another colleague who, over the course of learning more and more about technical analysis and the value it can bring, has just taken something comparable to the momentum ranks I just showed you and just brought it into his process, right? So he has this list of names that are like, he knows what his fundamental view is. He's a very, very talented, very smart, very good fundamental investor, has a great team. But where they were struggling was on that risk management, knowing when to engage versus to not engage. So he now has this list of names that he wants to own, and he won't buy them unless the technical score is positive, right? And this is a guy who's very experienced, has great numbers, great performance, but his ability, and I credit him for his flexibility and frankly his wisdom to just recognize that he doesn't have all the answers, and sometimes the market actually, more often than not, you do want to listen. So there's an example of a guy who just brought a simple technical ranking into his process. It's now one of the columns in his decision tree, and if it's as you screen stocks out of that list for candidates that you can't buy it, that's one of the criteria. If it doesn't have a positive technical score, it's beyond the simple momentum rank that we talked about. It's just one of the formulas that I've developed over the years, and so he just eliminates names right out of his idea set. So he can use it to scale his process. So he's got this list. He would buy any one of these companies, but he can take a whole swath of them and get rid of them right now because they're doing this, they're not doing that, right? So it's a scalability that technical analysis brings to the process. So then beyond that, it becomes really how open the culture is at your firm, and the more you can become an advocate for technicals within your firm, openly advocate, that this is how I manage money, and this is why. And of course, I'd be happy to, come to any firm and just kind of advocate for technicals that wants me to come and do it. I'd be happy to do it. But that's going to be company dependent. Sometimes you have to have your CMT and not put it on your business card, and other times, because it's just controversial. But other times you can be very open about it, like we were.
Well, and with that, I want to thank, first of all, everyone for sticking with us, for going a little bit over the hour. There's a lot of great content that I wanted everyone to stick around and hear. I'm so happy. Great questions. Thank you for everyone participating on the question side. And especially thank you to you, Dave. It was a great presentation. We really appreciate your taking your time. And you're going to share your materials, correct?
Yes, we will. We've already sent it to you guys. It's the PowerPoint in PDF form. And then at the end of that PowerPoint or that PDF, of course, we'll have the list of books that I listed. And if there were other questions that we didn't get to that you want to send to me, I'd be happy to answer them on the side and send, respond to you with the answers to those.
Excellent. So
Happy to do that.
anyone, if there are follow-ups, please let us know.
Right.
Otherwise, the material will be available, the recording will be available. And again, Dave, thank you so much for doing this.
My pleasure. Thanks for having me.